Let me go and do a quick survey of this, looking at Russia and Ukraine, their economies, what can be affected, what can be denied through all that. Just to set it a little bit in context, this first slide here shows the first 180 days of price performance of the S&P 500 for three major conflicts: World War II, Korean War, and Vietnam. And then you can see the gold squiggle in there is the start of the Russian invasion, and I took it from February 17th. So you can see that we're inside the envelope of price performance, so far into this conflict with regard to other major ones. So this is just a thought in terms of where we might go. On the next slide, you can see what are the exports in terms of who does Ukraine sell to, and you can see that their principal trading partners there are Russia and China, diversified across Europe. An interesting note is that Turkey receives 75% of its grain from Ukraine and Russia. So that's pretty interesting. So we're looking at this chart in the next couple to see, obviously Ukraine is impaired. What are the potential impacts based on looking at who their trading partners are and what they're selling. Go to the next slide. You can see here the vast majority of exports are in the grain area. And you can see it's all broken down, a total of about 35% overall. In combination, Russia and Ukraine are major exporters of grain to the rest of the world. As the note here, 29% of wheat, 19% of corn, and 80% of sunflower oil. So you can just imagine, the amount of impact that these reduction of these types of exports, may have. Go ahead and next slide. In terms of imports, who are the trading partners on that side of things? And you can see that once again, Russia and Belarus are major, partners from the Ukraine there. And there are, others, once again, China figures large, Turkey, Germany, other EU countries. So, again, on the in terms of what is brought into Ukraine, you can see really two major blocks there: energy and automobiles. So otherwise, it's pretty well diversified across things. But once again, energy is imported primarily from Russia. As Stephen pointed out a little earlier, the Russian ruble has really collapsed. The quoted rate, has gone down to 160. The central bank rate at about 112. So, and interest rates, have been raised to 20%. To say it's totally understated to say that this is like so adverse for the Russian economy. Next slide, please. We talked a little bit about reserves earlier on. This one breaks it out. I did this chart last week, and then it was supplemented last Monday from an article in the Wall Street Journal, which I snipped the chart to the far right there. And all in total, X the gold, X the China, 65% of the Russian reserves are in currencies that could be denied to Russia. So they're in a really deep spot. Mark was talking about it a little bit earlier. Essentially, the only thing they really have that's easy to work with is China RMB. And then I've just noted reports this morning that gold prices are softer this morning because of potential selling, by gold, by Russians, and mostly citizens as opposed to the country, itself. But, it gives you much restricted ability for Russia to participate in commerce. Here, in terms of, who Russia sells to as far as their exports, once again, China and Belarus, two friendly companies or countries, are their major trading partners. Germany is somewhat on the ropes here because the vast majority of Germany's imports, 87%, is Russian energy. So it's a tough go if others decided to step back. Next slide, please. In terms of what Russia sells, no surprise here. It's mostly energy, crude, gas, coal. It's 53% of all exports are in the energy sector. Next one. As far as the import partners, you can see again, China and Belarus are major ones, and the rest, Germany is up there. I'll talk a little bit more about the China relationship with Russia in terms of their natural gas in just a moment. But let's go to the next slide. And this slide I thought was pretty interesting because it looks at where does China get her goods. And the interesting thing about this is that if you look carefully at this bar chart, you'll see that China is in all but one of the groups noted. So that means that supplies to China, to Russia, can be supplied for the most part by China. Obviously, all the other countries, are there as well. But at least Russia has an open door, with China with regard to these imports. You can go to the next slide. So here are our commodities that China supplies, or I'm sorry, Russia supplies to the rest of the world. And the point of this slide is what is the maximum amount of harm that Putin could potentially impose where he has, where he's a major player on these commodities, but it doesn't cost him that much. And really the poster child here is palladium, which of course is being used in auto catalytic converters. So Russia supplies, almost 45% of the world's palladium, yet it's only 1.5% of Russian exports. Consequently, if Putin decided to cut that off, it wouldn't be that big of a deal for him, but it would be major impact on the rest of the world. And then you can see sort of trading off between the length of the bar to the right and the numbers to the left in terms of how much it costs him versus the potential impact on global commerce. Next slide, please. So here's the slide I was referring to. So last year, the market value for Russian exports in natural gas was almost $56 billion. Of that, Russia negotiated a contract with China through Gazprom so that they would supply to them at a fixed price, which roughly equates to 24% of that $56 billion. So there's very heavy trade between China and Russia. It's interesting, Russia depends a lot on China for goods. China depends on Russia a lot for energy. And you can see the relative order of magnitude that's there. Yeah, next page. So here, let's take a look at European dependence on Russian oil and gas. You've got gas on the left, sort of the blue charts, and then Russian oil with kind of the army green charts to the right, of which Poland and Hungary are very heavily dependent, almost up to 100% in certain circumstances on Russian energy. Other countries a little bit less, but still the relative numbers are pretty high. So any cutoff of Russian energy to the rest of Europe is going to hurt. Let's just be frank about it. Next page. Taking a look at, in terms of what the conflict has done to oil, this is a historical chart of the price of oil going all the way back into the 1800s with the discovery in Pennsylvania. You can see that the light green trace there is constant 2019 dollars. So back in the 1800s, the initial price for oil was around $130 a barrel in 2019 dollars. The nominal dollar price is there in the dark green line. But you can see that last week, we met that high point at $130.50. As of the close yesterday, oil was at 103. This morning, it's down as much as 95. And Brent has broken through the $100 mark as well, down to 99. So we've seen a little bit of relief, but nonetheless, I don't think we've necessarily seen the end of this, but I think that elevated oil prices are going to be a consequence. Next slide. One thing I wanted to touch on was trying to get a little bit more into Putin's head in terms of, why is he doing this? And I'll certainly defer, to my other colleagues who know better, but
I was going to
very
say
interesting.
we might want to defer this one to those who are culturally close to it.
Yeah, yeah. The only thing that I'll mention is these three philosophies of Neo-Eurasianism, Russian traditionalism, and Holy Russia, which is the combination of church and state that's in there. So I'll defer, but I think that this is a moral cause in Putin's mind, and it goes beyond a lot of just realpolitik, type of considerations. So, so where, kind of my takeaways, and, I think Stephen did a tremendous job in explaining a lot of these, but clearly inflation is going to persist for us. I think it's going to be higher than what people had expected or hoped for, pre-invasion. Stagflation now is certainly a much greater risk than it was before. And we can see that there are numbers that are starting to come out showing easing in growth rates. So that's going to be a tough one. As Stephen has said, the US Fed is just really, and other central banks are between a rock and a hard place. And I think even more importantly is that, potential endpoint outcomes are far more probable. I mean, we could see inflation running away in this case. We could see, a significant recession coming out of all this as well. The whole notion of security issues, once again, kind of, we were talking about that because of COVID, but now it's like just fill in the blank, energy, food, cyber, you name it. Everything now is a security issue. And so once again, I think that you have to be, very careful about, where you're picking your points to invest. The continued, deglobalization trend is only being accelerated, and that's related very much to this notion